The 10-year yield touching its highest level since April earlier today. But our next guest says the rise in yields could be a false flag. Let's bring in Fundstrat Head of Research and Fundstrat Capital CIO, Tom Lee. He's also a CNBC contributor. Tom, good to see you. Okay, so let's start there with the yield impact. What might people be reading wrong, you think?
Well, I wouldn't say markets are necessarily reading it wrong, but I would say as uncomfortable as we are seeing yields at near one-year highs, I don't think that this is going to be the level we see a few months from now. And I think that's more important because ultimately, if yields begin to fall because inflation pressures are easing, or if the job market is a bit softer than expected, it really puts the Fed back in focus. So I guess what I would just say is it's not comfortable to be here at where yields are. I don't think it really breaks markets, but I don't think yields are necessarily moving higher over the next few months.
Hey there, welcome back to the channel. Are we about to see the markets shake things up in 2025? Rising bond yields, a cautious Federal Reserve, and some unexpected twists in consumer behavior are already setting the stage for what could be a wild ride. Stocks are struggling, Bitcoin's on the edge, and everyone's asking, what's next? Stick around, because today we're breaking down exactly what's happening, why it matters, and how you can stay ahead of the game. Let's dive in. First up, bond yields are climbing, and trust me, this is a big deal. What's driving it? Strong economic growth and inflation that's outpacing expectations. When bond yields go up, it usually spells trouble for stocks, especially high-growth tech names. Why? Because higher yields make future earnings less valuable in today's dollars, and investors start looking elsewhere. Here's the kicker. The December jobs report smashed expectations. We're talking way stronger than anticipated employment numbers, and that sent Treasury yields soaring even more. The result? Rate cuts that people were hoping for this year? Yeah, those seem way less likely now. In fact, some whispers in the market are about potential rate hikes down the line. Historically, bear markets for bonds can last decades, so this trend could keep pressure on stocks, especially if inflation remains stubborn. It's like a ripple effect. Bond yields move, and the whole market feels it. Next up, let's talk about the Federal Reserve. Jerome Powell and the team are navigating some tricky waters. The U.S. job market is strong, inflation is still sticking around, and the Fed is watching one key number like a hawk: core PCE inflation. Right now it's at 2.8%. But here's the thing, if it ticks up above 3%, we could see the Fed shift gears in a big way. And that's not all. Proposed tax cuts, potential tariff adjustments, and rising consumer inflation expectations are just adding fuel to the uncertainty fire. While some experts think the Fed might hold steady or even cut rates later to protect the labor market, there's still a real chance of rate hikes. The result? A lot of indecision and a lot of market volatility. It's a game of waiting and watching, and the stakes are high. Let's zoom in on the stock market. It's off to a rocky start in 2025. The Dow just had its worst opening since 2016, dropping almost 700 points in one day. That's a major gut punch. And it's not just the Dow. Big indexes like the S&P 500 and NASDAQ are also feeling the heat. Sectors like real estate, which are super sensitive to interest rates, are taking some of the hardest hits. Why? Remember that strong jobs report we talked about? It drove up bond yields, and rising yields typically hurt stocks, especially growth-focused ones. The fear in the market is real. The CBOE Volatility Index, aka the fear gauge, has already jumped 12.6% this year. That tells us one thing. The markets are nervous, and if you're investing, you need to stay sharp. More insights coming up from Chris Vermeulen, Chief Market Strategist at the Technical Traders. Is this the end as we know it? We would just have to find out. So what does all this mean for crypto and Bitcoin? Higher rates and a shaky stock market could actually boost Bitcoin's appeal as a hedge against inflation. But let's be real. Bitcoin isn't immune to the broader market sentiment. If uncertainty grows, we could see some wild swings in crypto prices too. Let's listen to more insights from Tom Lee, Fundstrat's CIO, as he breaks down what's happening with the Russell 2000 and more.
Well, it's particularly uncomfortable, arguably, for small caps. Early last year, probably around this time, you made a bold call on how much small caps could rise. You've moderated from that since. But where do you see small caps going now? Why didn't the big pop that you projected for 24 pan out?
Yeah, small caps have been disappointing. I mean, unfortunately, I think there's been a rug pull on those names a few times, so I think investors are going to be very wary. But to us, I think the roadmap for 2025 is still one where the opportunity for stocks to have much better breadth widens, because not only do we have an incoming administration that is pro-business, and I think it is going to boost CEO confidence. It's pretty evident now, even seeing it in both ISM readings recently. But that's going to be a better environment for mergers. So to me, while small caps have been big laggards, actually for the last 10 years, this 10-year underperformance to the S&P is the worst in actually almost 100 years. So second only to 1998. And then from a valuation perspective, small caps are still much more attractively valued. The median PE is around 11 times, and that's almost 7.7 turns cheaper than the S&P. So it's been tough, John, to be overweight small caps, but I think they're going to work in 2025.
Okay. I do want to get your thoughts on some of the riskier assets or the riskier parts of the market that, or I'll use the word maybe potentially more speculative. Case in point, the quantum computing stocks, they had a huge move higher. Jensen Huang from NVIDIA comes out yesterday, makes comments saying that, some of the supercomputers are still, and the full realization of supercomputers is still decades away, and you see all the stocks tumble. I know there's one that you like in your granny shots here. I believe it's IonQ. Just want to get your thoughts on what we've seen in some of these parts of the market and how to think about investing, if you should be investing in some of these more speculative or futuristic frontier tech-like companies.
I think investors do need to put a long-term lens on a lot of these important mega themes. I think quantum computing is in the earliest days. I don't think anyone can judge really whether it's 15 years away or 15 months. And I think people have made many mistakes over the past 20 years looking at things like social media and underestimating the adoption rates there, or internet, or even AI now. I mean, just think about 2 years ago, how many people were saying AI was going to actually take far longer than expected. That being said, I do think the environment for stocks hasn't been great for the last 3 weeks. I think it's really gotten people into a recency bias, thinking, look, we've neared a top, or that stocks are just awful now. I think we're getting close to the point where, you should be betting really and leaning heavily against that. I mean, even look at AI sentiment, it's almost back to negative. But Morgan, regarding quantum specifically, it is a pretty innovative technology. I think these are going to be high volatile names. And so until we get back to risk on, they are going to be tougher names to own, but I don't think that means you have to sit them out in 2025.
I think it is. So if we take a look at this kind of mixed indicator, this is the SP 500 equal weighted. So it's not tech heavy. It's the small cap stocks and it's the micro cap stocks. And if we just look at it, we can see it's gone into a huge sell-off. It's got a bear flag pattern, and now it's breaking down, and it shows we could have the markets really collapse. And the reality is a 60-40 portfolio since the high in 2022 hasn't made any gains. You're actually at a loss over the past 2 years. And that's telling us that the majority of stocks aren't doing very well. So I think people need to be aware, if you look at the high yield dividend stocks, like this is the SP 500 high yield dividend stocks. This is what most investors are invested in. They all hold big dividend stocks. They have dropped. They got this tight bear flag pattern. It is showing we could see a huge drop in dividend stocks. And the crazy part is the SP 500 is down 3 or 4%. And we're seeing the dividend stocks, which are supposed to be safe havens, high yield, safe plays, they're down 3-4 times what the SP 500 is down. And it just goes to show money is definitely flowing out of this market. While we see the indexes going up, when you look underneath the hood, we have investors rotating out. Warren Buffett continues to load up on cash. He's liquidating positions. BlackRock is selling off, I think, lots of real estate. They're huge holders in real estate. They're selling real estate at losses. And we don't really hear much about it because I think these big players have so much weighting in it. They're just trying to get rid of real estate before the real estate bubble breaks. But I think overall, this market is not nearly as strong as people think. And I think we're going to have another sharp leg down. And the monthly chart of the SP 500, as you and I were just talking before we hopped on this call, David, is really, really important, I think, for people to understand. And I use Fibonacci extensions. It's the most powerful tool, the simplest tool to predict upside targets and pullbacks.
Yeah.
And based on the rally that we had to 2022 high down to the 2022 low, we can drag that forward to where that price is. And the SP 500 came up in December, tagged that level, and now we're starting to roll over. Now, this same chart pattern has happened on gold. It's hit 100% measured move, and Bitcoin. So we have equities, gold, and Bitcoin all doing the same thing on the monthly charts. So that is a very powerful sign, a warning sign that the end may be closer than we think. And as you just mentioned, I think this could be the start of a much bigger correction. I think we could see a big pullback of potentially 15 to 25%. And then depending if the market can hold that, we might actually see another much larger drop after that. I think this year is going to be a very tough year for investors and anyone holding equities.
So let's sum it all up. Rising bond yields, a cautious Federal Reserve, and a volatile stock market are shaping up to make 2025 a year of big decisions for investors. For Bitcoin and the crypto market, this could go one of two ways. On the positive side, higher interest in Bitcoin as a hedge against inflation could drive more adoption and price momentum. People might see Bitcoin as a digital alternative to gold. On the flip side, Bitcoin isn't completely immune to broader market fears. If stocks tumble or uncertainty spikes, we could see Bitcoin's price follow the same roller coaster. Either way, staying informed is your best weapon in these unpredictable markets. If you enjoyed today's breakdown, make sure to like this video to support the channel, share it with your friends who need to stay updated, and hit that subscribe button so you never miss out on our market insights and crypto updates. Thanks for watching, and I would see you in the next one.